How to perform a valuation of startup? Startup can be a complex process due to the unique characteristics and risks associated with early-stage companies. Here is a general framework for performing a startup valuation. Understand the business model. Gain a thorough understanding of the startup's business model, products or services, target market, competitive landscape, and growth potential. Assess the startup's industry, market size, and market trends to evaluate its growth prospects. Identify key value drivers. Identify the key value drivers specific to the startup's business model and industry. These could include factors such as user base, revenue growth rate, customer acquisition cost, customer lifetime value, intellectual property, technology, team expertise, and barriers to entry. Select appropriate valuation methods. Determine the most suitable valuation methods based on the startup stage of development, available data, and industry norms. Common methods include A. Comparable transactions or market multiples. Look for similar startup transactions or acquisitions in the industry and use their valuation multiples, such as price to revenue or price to user ratios, as benchmarks to estimate the startup's value. Discounted cash flow (DCF) analysis. Forecast the startup's future cash flows, considering factors like revenue growth, profitability, and capital expenditure. Discount the projected cash flows to their present value using an appropriate discount rate that reflects the riskiness of the investment. Venture capital method (VC method). Calculate the post-money valuation based on the expected exit strategy and the desired return on investment (ROI) for investors. This method considers the expected future funding rounds and the dilution of ownership. D. Scorecard method. Assess the startup's performance against various factors and assign scores accordingly. Use a score-based approach to determine the valuation based on the average scores of comparable companies. Gather and analyze data. Collect relevant financial information, including revenue, expenses, and growth projections. Consider non-financial factors like the strength of the team, market traction, intellectual property, and competitive advantages. Use this data to inform your valuation assumptions and inputs. Assess risk factors. Identify and evaluate the risks associated with the startup, such as competition, market volatility, regulatory challenges, intellectual property risks, and execution risks. Consider the startup stage of development and the likelihood of achieving its projected growth. Sensitivity analysis. Perform sensitivity analysis to understand the impact of changes in key assumptions on the valuation. Assess how variations in factors like revenue growth rates, discount rates, or exit multiples affect the startup's value. Document and justify the valuation. Clearly document the assumptions, methodologies, and rationale behind your valuation. Provide a comprehensive report that highlights the key findings, risks, and drivers influencing the valuation. It's important to note that valuing startups involves a degree of subjectivity and uncertainty. Working closely with industry experts, utilizing market research, and seeking input from experienced investors can help enhance the accuracy and credibility of your valuation.